We all know that markets go up and markets go down. The cycles may not be entirely predictable, but there is certainly a pattern to them. We tend to see market downturns once every 5 to 10 years or so, but depending on how granular you want to look at an investment, you could see the cycle completing much more frequently than that. And some investing strategies look to take advantage of this. With that in mind, today we're going to be discussing the 4 phases of market cycles, how to recognize them, and what they mean for us as investors. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to my Patreon page. This is the best way to show your support for this channel, and in addition to that, you can also get early access to new videos and exclusive content such as spreadsheets based off the ideas we discuss in these videos. The spreadsheets will allow you to play with your own numbers and see how big of a difference some of the ideas we discuss can make for your own personal financial situation. The first phase of any market cycle is the accumulation phase. The primary characteristics of this phase are that the market has bottomed out, and early adopters, such as speculative investors spying an opportunity, value investors loving what their indicators are telling them, investing insiders, or just other smart investors, are beginning to slowly buy back in. At this point in time, they often are seen as contrarians in the general investing community, because the general sentiment is still pretty bearish, and understandably so. After all, the accumulation phase only really begins after the market is bottomed out. So while there may be some indicators to suggest that the worst may be over, it's far from a certainty. Add to that the fact that unemployment typically remains relatively high and is sometimes even still climbing during this phase, as well as the fact that GDP is down, if not outright negative, and the fact that during this time there will be news articles preaching doom and gloom coming out seemingly every single day, and you can see why there's still going to be a lot of uncertainty. To give an example of this accumulation phase in action, let's take a look at the S&P 500. By September 1974, the S&P 500 had just bottomed out after the crash of the early 1970s, at around $63 a share per Yahoo Finance's monthly average adjusting closing price data. Nobody knew for sure at that time, but a rally was about to begin, which would see the market climb to over $100 a share by January 1976. But again, a lot of people wouldn't have guessed that that would be the case at the time, given the other relevant statistics that were coming out in the news. The market was roughly 46% off its recent highs that were set back in December 1972. Unemployment had been creeping up over the past year from as low as 4.6% in 1973 to 5.9% in September 1974 and to as high as 9% by May of 75. Unemployment was still actually holding relatively firm at around 7.9% by January of 1976 when the markets broke the $100 mark once again. Year over year, real GDP growth had fallen from nearly 7% in the final quarter of 1972 to negative 0.6% by the third quarter of 1974. It would drop further still to negative 1.9% in the fourth quarter and negative 2.3% in the first quarter of 1975. We see this pattern play out again during the crash of the early 1980s, with the S&P 500 setting a new high of $140 in November of 1980, before falling to around $107 by July of 82. Over the next 5 months, it would rally all the way to a new all-time high of nearly $141 and would continue climbing from there, but such an outcome didn't look too likely in July. Unemployment had risen from less than 6% to close out the 1970s to around 7.5% by November of 1980. It grew to around 9.8% by July of 1982 and rose further still to almost 11% by the end of the year when the market was setting its new all-time high. It would take another 7 months for unemployment to fall below the 10% mark, and nearly a year and a half for it to drop below the 7.5% mark we saw at the previous height of the market. Now you may be saying to yourself, come on Daniel, GDP growth and unemployment are lagging indicators. The stock market is forward-looking. That's part of the reason we see such a decoupling between the two, and that's true. But you'd be surprised how easy it is to forget that in the heat of the moment, especially when we don't have the benefit of hindsight to know how things turned out. But that's generally what the accumulation phase looks like. It begins with that bottoming out of the market, value starts to become more attractive, and so early adopters begin slowly wading back into investments, but they are in the minority. since overall sentiment for the majority of the investing community is still pretty bearish. Over time, the lagging statistics begin to catch up with the market, and the views shift from negative to neutral, signaling the shift into the second phase of the market cycle. The second phase of any market cycle is the markup phase. This is probably the most fun phase of any cycle for an investor and is split into three segments: the early, mid, and late markup phase. The primary characteristics of the early segment of a markup phase is a market that has experienced some stability and growth recently, primarily off the back of the late accumulation phase, with those early majority of investors, such as the technical investors, beginning to jump on the bandwagon. As a result, growth begins to speed up, but nothing's too alarming yet. The media begins running stories discussing the possibility that the worst may be over, but unemployment still remains relatively high, and there's still potentially reports of new layoffs coming in from certain sectors of the market, so there's still some uncertainty. The mid-markup segment is characterized by a change in market outlook. While the accumulation phase carried with it a mostly bearish outlook that eventually turned neutral, the mid-markup phase sees the outlook shift to be more bullish, and as a result, a few things usually happen. First, the late majority of investors begin jumping on the bandwagon, and prices shoot still higher. Second, because of this, some of the more speculative investors that we saw getting the ball rolling in the accumulation phase begin to take their profits and sell out of the market before things get too overpriced. And third, as a result of the good times really starting to roll, greed slowly begins to outweigh fear for most investors. The late markup segment is characterized by a brief time where prices begin to level off, or at least the rate that the prices are growing begins to slow down. Those investors who elected to stay on the sidelines, either by choice or as a result of previous hardships from prior downturns keeping them out of the investing world, begin to enter the fray. This often includes your local farmer Fred and that one guy you've never met before that just so happens to be filling up his tank one stall over from you at the gas station that was oh so happy to give you stock tips. As a result, we usually see a comparatively massive and fast upswing in prices as basically all but the most active and savvy of investors are piling in as much of their cash as they can for fear of missing out on the next big move. You could make the argument that at this point the outlook for the market goes from bullish to downright euphoric. Perhaps the most well-known recent example of the markup phase happened in the 1990s. Sure, there was a little turbulence in the early 1990s, but the second half of the decade in particular was just a run-up. I mean, at times it seemed that you almost couldn't not make money by investing. To give you an idea, in October 1990, the S&P 500 was closing at around $304 a share. By December of 91, it had broken $400. By March of 95, it had gone above $500. In February of 98, it sped past $1,000. And by the end of the decade, it was sitting at almost $1,500. So what we're seeing here is an accumulation phase beginning in 1990-91. The market was still off its previous highs, but the downward trend was beginning to reverse. Between 92 and 95, we saw a period of slow but steady market growth, as we would expect in the early markup phase. From 95 to 97, we start to see a noticeably faster growth line take shape as the outlook becomes more bullish and more investors get into the markets. By September of 97, the S&P 500 was closing at around $950 a share, and over the next year or so, it would go up and down a bit, but still end up right around $950 a share by August of 98. But by this time, greed and that fear of missing out is really starting to take over as more and more people begin jumping into the markets. As a result, we see that characteristic sign of the late markup period and that last big upswing for the year and change in this case that closed out the millennium. But since we know that markets cycle, we also know that no upswing can go on forever. So let's move on to phase 3, distribution. So the third phase of any market cycle is the distribution phase, and the primary characteristics of this phase are that sellers begin to dominate. The bullish and possibly even euphoric outlooks of the late markup phase slowly begin to grow more mixed. It's not uncommon for there to be what are sometimes referred to as double or triple tops in the market during this phase. A double or triple top is a short period of time where the prices for a market are trading within the vicinity of its prior peak and sometimes even slightly exceeding them, but not really exploding anymore. For instance, in August of 1999, the Dow Jones Industrial Average was closing at around $11,350 a share per Yahoo Finance Finance's data. During the next couple of years, it hovered at around that 10 or 11,000-ish mark, give or take a few $100s, and after bouncing around a little bit, it rallied back to break a new all-time high in December of 99 and again in January of 2000, closing at around $11,550 a share and $11,750 a share respectively. After that, it would fall back into trading into that $10,000 or $11,000 range until about September of 2001, with the exception of April, August, and September 2000, when it had days that were closing around 11,400, again, nearly setting another all-time high. However, this scenario isn't always the case. We need look no further than the NASDAQ Composite during this same time period. The NASDAQ set a high of over $5,100 in March of 2000, but would not come anywhere close to that for the next several years. Nevertheless, the distribution phase is characterized more by a transition from euphoric to bearish than by the actual depth of price drops. As a result, it's a very emotional time to be an investor, with frequent shifts between rampant fear, rays of hope, and occasionally even greed, as it sometimes looks as if the market is getting ready to take off again. And it's a pretty unpredictable time as well, since the length of this phase can vary quite wildly from market cycle to market cycle and market to market as a whole. Given this, it should come as no surprise to anyone that many investors begin to jump ship during this time, hoping to break even or at least avoid a potentially big loss down the road. The fourth and final phase of a market cycle is the markdown phase, and it's unquestionably one of the most painful times to be an investor, as it's when the biggest portion of the price crashes take place, and naturally sentiments become very bearish. If you're an active trader, you're dealing with regrets about not selling your investments soon enough, assuming you're still in the market. You may try to hang on to your investments for a time in the hopes of a rebound, but in most cases, as the market continues to drop further and further, many active investors will eventually give up on the investment and eat the loss. If you're a more passive buy and hold investor like I am, and especially if you're a fairly new one, you're having to handle all the stress created by news headlines proclaiming the doom and gloom that carries on into the accumulation phase. You're wondering whether this time will be different and whether a recovery really is going to come around the corner. Thankfully, history has shown that as difficult and painful as the markdown phase can be, there has always been an accumulation phase that does eventually come around the corner. Eventually, prices get to the point that those speculative and value investors are willing to get back into the fray. It's all part of the economic machine. So as active investors, it's important to keep an eye on the other markets available to you, as they may not be in the same phase as the one you're currently invested in. For instance, we've talked mostly about the stock market today, which tends to go through this cycle once every 5 to 10 years or so, as I said. But that doesn't mean that every market sector within the broader stock market is on the same timeline. And there are other asset classes that tend to operate on different timelines as well beyond the stock market. Real estate tends to have longer cycles, for example. So diversifying your funds across those different sectors and asset classes can be crucial to long-term success. And as a passive investor like myself, it's important to focus on what we can control, such as continuing to budget and continuing to invest, because eventually the tide will turn again, and we want to be able to make the most of it when it does. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.